Welcome to our training on mezzanine financing. This is a topic that is crucial to your understanding of one of the main stages of investing in private equity investments. This video will help you to understand the basics of this stage as well as its role in the overall financing. Mezzanine refers to a claim on a company's assets that is senior only to that of common shares. Mezzanine financing offers a way for publicly and privately held companies to attain financing without going public and potentially ceding ownership of their company. It is a blend of traditional debt financing and equity financing, reaping some benefits of both. Like equity financing, mezzanine financing is an unsecured debt, requiring no collateral to be put up, unlike traditional bank loans. Like debt financing, mezzanine financing is very fluid and does not necessarily involve giving up an interest in the company. Mezzanine financing relies on very high interest rates in the 20 to 30% range to make it profitable. Unlike a bank loan, mezzanine financing does not hold real assets of a company as collateral. Instead, lenders offering mezzanine financing have the right to convert their stake to an equity or ownership in the event of a default on the loan. Mezzanine financings can be completed through a variety of different structures based on the specific objectives of the transaction and the existing capital structure in place at the company. The basic forms used in most mezzanine financings are subordinated notes and preferred stock. Mezzanine lenders, typically specialist mezzanine investment funds, look for a certain rate of return that can come from one or a combination of the following. Cash interest. A periodic payment of cash based on a percentage of the outstanding balance of the mezzanine financing. The interest rate can either be fixed throughout the term of the loan or can fluctuate or float along with the LIBOR or other base rates. PIK interest. Payable in kind interest is a periodic form of payment in which the interest payment is not paid in cash, but rather by increasing the principal amount by the amount of the interest. For example, a $100 million bond with an 8% PIK interest rate will have a balance of $108 million at the end of the period, but will not pay any cash interest. Ownership. Along with the typical interest payment associated with debt, mezzanine capital will often include an equity stake in the form of attached warrants or a conversion feature, similar to that of a convertible bond. The ownership component in mezzanine securities is almost always accompanied by either cash interest or PIK interest, and in many cases both. The basic forms used in most mezzanine financing are subordinated notes and preferred stock. Mezzanine lenders, typically specialist mezzanine investment funds, look for a certain rate of return which can come from cash interest, payable in kind PIK interest, or ownership. Mezzanine lenders will also often charge an arrangement fee, payable upfront at the closing of the transaction. Arrangement fees contribute the least return and are aimed primarily to cover administrative costs and as an incentive to complete the transaction. In structuring a mezzanine security, the company and lender work together to avoid burdening the borrower and the full interest costs of such a loan. Because mezzanine lenders will seek a return of 14 to 20%, this return must be achieved through means other than simply cash interest payments. As a result, by using equity ownership and PIK interest, the mezzanine lender effectively defers its compensation until the due date of the security or a change of control of the company. Mezzanine financings can be made at either the operating company level or at the level of a holding company, also known as a structural subordination. In a holding company structure, as there are no operations and hence no cash flows, the structural subordination of the security and the reliance on cash dividends from the operating company introduces additional risk and typically higher cost. This approach is taken most often as a result of the structure of a company's existing capital structure. Mezzanine financing is often used in leveraged buyouts or real estate financing. In leveraged buyouts, mezzanine capital is used in conjunction with other securities to fund the purchase price of the company being acquired. Typically, mezzanine capital will be used to fill a financing gap between the less expensive forms of financing, such as senior loans, second lien loans, high-yield financings, and equity. Often, A financial sponsor will exhaust other sources of capital before turning to mezzanine capital. Financial sponsors will seek to use mezzanine capital in a leveraged buyout in order to reduce the amount of capital invested by the private equity firm. Because mezzanine lenders typically have a lower target cost of capital than the private equity investor, using mezzanine capital can potentially enhance a private equity firm's investment returns. Additionally, middle market companies may be unable to access the high-yield market due to the high minimum size requirements, creating a need for flexible, private mezzanine capital. In real estate finance, mezzanine loans are often used by developers to secure supplementary financing for development projects, typically in cases where the primary mortgage or construction loan equity requirements are larger than 10%. These sorts of mezzanine loans are often collateralized by the stock of the developing company rather than developed property itself, as would be the case with a traditional mortgage. This allows the lender to engage in a more rapid seizure of underlying collateral in the event of default and foreclosure. Standard mortgage foreclosure proceedings can take more than a year, whereas stock is a personal asset of the borrower and can be seized through a legal process taking as little as a few months. Thank you once again for your time and attention, and this is BusinessTraining.com, where you can earn a master's level qualification to make more money.